All right. Hello, everyone. We will start here in about 2 minutes. We're giving our guest of honor an opportunity to join us. But I wanted to jump in and just welcome you all to our Builders U, our inaugural Builders U Todd Talk. Today's session is part of our Builders U Lunch and Learn professional development series. And we are so very excited to have you here with us today. I'm Mernice Oliver. I'm your Senior Manager of People Development, and I am very excited to have you here for another engaging and insightful session with Builders U. These lunch and learns are all about bringing you valuable knowledge and helping you to grow within our organization. Our goal really is to leverage the power of learning and development, which not only just helps us to build high performance teams, but it also helps us to build a high performance culture and ultimately in overall building a high performance organization. So today's session is all about how our organization makes a dollar. Todd is going to take us behind the scenes to help us to understand really the bigger picture of our business and how we all contribute to the overall success of the organization. Our hope is that today you walk away, armed with some deeper insights into that will help you really think more strategically about your role and how your role impacts our success. So before we dive in, I want to share just a few exciting updates on our upcoming Lunch and Learn series. So go ahead and mark your calendars for May 21st. Excuse me. For those of you that don't know, I'm recovering from the flu, so I apologize for that. Mark your calendars for May 21st, where we'll be discussing thriving through change and building adaptability in a dynamic and high performance workplace. Change is one thing that is certainly constant. We can't get away from it. And we want to equip you with the tools to help you navigate it with confidence, but not just confidence, but also resilience. And so stay tuned to the bridge for more details. Now, let's get started. I got a few little bit of housekeeping tips. For those of you that are just joining us, please be sure that you stay muted, that you mute yourself. We do want to make sure that we're protecting the integrity of this recording because we will share this as part of our Builders U library. So we want to make sure we have a nice and clean recording for you. But then secondly, we want to encourage you to utilize the chat. For all of your questions and all of your comments. I will be monitoring the chat. I'll also be driving the slides for Todd today. And so if you can hear me okay, and if you can find the chat, please type me a number 1 in the chat. That lets me know that you can hear me okay, that you're engaged and you're ready to get started. And then I'll make sure that we get your questions and that we acknowledge your comments as we go throughout today's presentation. And with that, it is my pleasure to introduce our speaker, Mr. Todd Campbell. Todd, of course, is an expert at what we do here at Builders. And so he's going to break it down. He's going to come in and talk to us about how our organization generates revenue and really how we sustain ourselves for success. And so without further ado, Todd, are you ready to take it away?
I am, Mernice. Thank you. I came in off of my computer, which was causing technical difficulties. So I'm on my iPad, so I hope volume is okay. Is that right?
Your volume is perfect. I can hear you. Yep. But for those of you, let us know in the chat that you can hear us. Type us a 2 if you can hear Todd okay. So let us know that everything is going well. I see those 2s coming in, Todd. So we're good to go. I'm going to go ahead myself and drive the presentation. Have a great presentation.
Yeah, that's great. So hi, everybody. And so first off, it's great to be together virtually. And the idea, how this came about is obviously Mernice and her team are always focused on, now that we've got this learning and development team, they're working hard to drive information and knowledge across the organization and really serve you as a customer. And so delighted that this opportunity has come up. So many times during the course of a year, as long as I've been here, and every insurance company I've been at, people always say, well, how do we make money? How do we, it's not quite like selling a book on Amazon, or gosh, any product they sell on Amazon now. Insurance is a bit different. And so since we're all professionals working hard together, trying to build the best thing we can, it seems to be valuable when folks go, oh, that's how it works. Okay, great. So I see our audience. There's a lot of folks who already know this, so I'm delighted you would join anyway. And maybe there's a question or two that you can help um, elicit more information out of this conversation. So again, delighted all of you would join. I think there's about 50 of us on the call, which I thought this might be 6 or 8 or 10 folks, but so obviously it's information hopefully that folks are after. And so I want to make it relevant and valuable to you for this time. I'm going to walk through a handful of slides that describe very high level how does it work, and then hopefully leave enough time at the end for a few questions. So let's call that maybe 30-35 minutes of discussion around the information being conveyed. But at the end of those slides, I did add quite a bit around our portfolio. And I saw that Chesley is on the call today too. She has a lot of interaction with our portfolio, Chesley Belcher. And that is integral to our business. And a few times I've spoken with folks around the company. We really get into the portfolio, and that's the money we manage to help drive our profits and keep our lights on and pay our bonuses and health insurance premiums. So that's the idea today. How do we make a buck? Why does it matter? And these are the things that, again, keep the lights on, pay our rent, health insurance, 401k match, all the things it takes to run the company. And if any time you want to pause and have a question, flag it up, get Mernice's attention, and we'll do our best to cover it. So with that, this is a quick chat. I know Tony just delivered a similar discussion to the onboarding group, and he probably will have a couple of points too by question. But let's kick off with, how do we make a dollar as an insurance company? So we're not unique to this, folks. This is an insurance company discussion. Crucially, we're a property and casualty company, as you all know. I'm U.S. chairman of a largish life insurance company that's publicly traded out of Canada. And we make a dollar in that company quite a bit differently. So this is for property and casualty insurance, like us, Chubb, Society Insurance, even some of our competitors who shall go unnamed. But so this is a P&C focused discussion. So what are the elements of income? So we can't talk about profit unless we talk about income. And basic business class 101, sales less cost of sales, gross margin. Well, in this case, we generate income from 2 primary sources: sales, which is everything that underwriting and marketing produce. So when the underwriting team books a policy and those dollars come in, those are our sales. When specialty, which is now approaching about a $70 million business, when those dollars come in, and those are gross sales. And then, so that's our top line. And then if you think about sales in another way, it's our investment portfolio returns. And we'll talk a lot about the investment portfolio. But think about dollars coming in from the sale of an insurance policy and dollars coming in from our investment portfolio. All those 2 things together, we'll walk through the earnings of those things. But those 2 things are kind of the very high level that makes this company tick. So when we have an increasing sales environment, which we want year over year, that's a good thing because it gives us more premium to earn on. And as you all likely well know, when we take in premium dollars, we can't call them ours on the first day. We have to earn those premiums over the policy period. So for a simple example, we sell a policy for $1,200. This is my basic math because I'm a basic math guy. And we divide that of 12 months. And so we can call 1,200 of it ours in the moment. So that is what we mean about earned premium. So that really looks forward. So as we grow our business, This is why it's so essential to have a growing book of business that's performing well, underwriting wise, because the larger that becomes, that means more earned premium comes through, and that is a driver of income
Hey,
in
Todd,
any one year.
do you
Yeah,
mind explaining the earned premium again? Your camera froze, and so I
yeah,
just got a couple of messages. Everybody
yeah.
missed that
I
part.
apologize for that, Mernice.
Okay,
That's because I'm on my iPad. While we do that, I'm going to walk down to the boardroom, and it might be a little bit better of a connection. We'll talk about earned premium in a moment. So I'm going to park that for a second, Mernice, and carry on if that's all right.
absolutely.
So if you want to jump to the next slide. Thank you. There we go. So what do we talk about? What do we mean when we talk about earned premium? It's the money we get to call ours, not the money that we put in, that we have to defer over the 12 months, what I just talked about when we earn a policy. And so we take in premiums collected, and then we talk about earning that premium, but we also have to pay claims. So essential part of our premium is the losses that are associated with that premium. And so a very simple calculation, we talk about premiums collected, we apply a loss adjustment expense, meaning losses, but we also book in, it's basically a legal fiction, IBNR, which is the incurred but not reported. And so those are really losses. So I've kind of lumped that into losses, meaning we do have to take premium and set it aside for the future because claims are going to happen. We just don't know when or how much. So there's a lot of science that goes into the work around setting aside money for a rainy day, as we call it. So that's what Mike Curtis and his team does when we think about future losses and how do we calculate that. So every insurance company in America that does what we do in the property casualty space always sets aside a piece of that money, that premium, for future losses. So I've lumped that all in. When we look at the dollars in, we apply losses and earn premium. We apply taxes to any profits there. That equals our net profit. So that's the premium calculation. I hope that's, again, very high level, but I hope that explains why does this matter? Well, it's a key financial metric, and we hold ourselves up against the industry and certainly to our regulators and to our reviewing organizations like AM Best. And it shows, are we efficient? Are we writing the right business? Are we having a very poor performing line of coverage that costs us more than we are taking in, so to speak? And that's that combined ratio being over 100%, as we talked about on the town hall recently. When we also look at this metric, the net premiums earned, again, that growing base of premium that speaks to a growing company, it's hugely important. It also helps us allocate our resources for future growth and future liabilities. A shrinking book of business is, unless it's intentional, is not a good thing. So we want to grow. We want to fight hard against the builders mutuals of the world in North Carolina, the FCCIs, the AmTrust, the CNAs, all of our competitors, and grow that business strategically. Obviously, profits are important because it helps us reinvest in our business, to hire the right people, to pay the right salaries, to attract good talent, to pay our dividends to our policyholders, to make us attractive as a competitor out in the space. And certainly, when we're profitable, it supports our solvency, and that is it speaks to our surplus growing and helps us cover claims and operating costs. So how we grow and how we earn that premium on a quality book of business is really the heart of our financial strength and our ability to hire and retain and grow not only a company, but grow our people. Okay, Mernice. Thank you. So let's talk about financial strength for a minute. So we talked about all that premium coming in and earning and hopefully producing good results. If you attended the town hall about a week and a half ago, we talked about the profitability of the company relative to our combined ratio. And combined ratio speaks to, is the company operating, one, is it writing good lines of business? And two, does it operate efficiently? So we talked about that combined ratio being a little bit high right now, but our underlying business lines of insurance, think about workers' comp, general liability, the specialty lines, every one of those lines of insurance today is running exceptionally well. In fact, most of them are at the forefront of the industry, or at least peer competitive. Why is that important? Well, it means we're writing good business. As many of you know, this company wrote GL from around 2013 to around 2019 before some of the team now here got a hold of that product and cleaned it up. That cost us a lot of money and it hurt our financial strength. So when I talk about good performing lines of insurance, it's crucial to our financial strength because it helps drive profits. Today, we should all be very proud that this company has a really nice reputation for growing surplus. In fact, you look at the top number there, we have 383 million in surplus as of year end because we produced a good profit. And we'll talk about that number. I think we produced about a $22 million profit after everything, taxes, paying everybody, running the company. And as we grow that surplus, of course, it makes us only stronger in the eyes of the world, our customers, first and foremost, our regulators, and certainly AM Best and our ratings organization that we have to work so hand in hand with. Excuse me. What makes up surplus? Well, again, it only grows when we're profitable. And surplus is a function of two things. Reserves, all that money that we can't earn yet, we talked about earlier, plus our so reserves plus surplus equals our total money under management. We'll talk about the portfolio shortly, but that number you've heard lately is about 1.1 billion. We talk about assets under management. And again, surplus is really made up of two things: our reserves and our free cash, our surplus. So that goes to our financial strength. Now, what do we do with all this money? And even if we have an unprofitable year, for example, we still have a lot of surplus. So you'll see companies producing losses when like significant natural disasters happen year on year, or very big losses. Even though the California fires were horrible, that's heavily reinsured around the world, just like we heavily reinsure our business, both in our core and our specialty. Notwithstanding that, that money still comes in and we still manage it. So that's ours to make a profit on and manage, hopefully with lots of discipline. We're going to get into some real detail on that shortly. We use two external advisors to help us manage our big portfolio. That's called SLC, which is Sun Life Corporation, one of the largest life insurers in the world. In fact, their chief investment officer runs one of the biggest portfolios in the world. Randy Brown, a very close friend of mine, from our London days. Well, it turns out when I joined here, Randy was already leading SLC's management. And so it's a big, small world. You never know how people turn up in your life again. And so Randy actually knew I got the job at Builders before I did. The other advisor we have is Cardinal. And Cardinal is a very, what I call esoteric money management advisor. They're very close to us, and they do an exceptional job. I would think a good example of Cardinal is, imagine our own chief investment officer inside the company, but we're just simply not large enough to afford one or two people to run that portfolio inside. We get very cost-effective strategic advice and counsel from Cardinal. In fact, we nominated Cardinal as the investment advisor of the year in the National Insurance Awards for investment managers, and they won. And we were up at that ceremony in New York at year end, and delighted to say Cardinal was recognized as the best investment manager advisor in the United States, and they're our partner. Cardinal's been an advisor to this company long before I arrived as well. And we vetted that relationship and delighted with the work they continue to do. Now, our capital base, think of the financial strength, that 383 million, it supports our ability to grow. And on the slide, it talks about take more risk. Well, why does that enable us to take more risk and hopefully drive profits? When you have that kind of capital behind you, we're always testing and modeling how much retention we can have. For example, Brent Johnson on the reinsurance side is deep in our getting ready for our insurance renewal in our core business right now. But we take certain retentions. For example, on workers' compensation, I believe we take $2 million, the first $2 million of any loss. That's because we have very strong capital behind us, very strong financial strength. So making a profit really matters because it allows us to get very strategic of how we reinsure or keep more to own of that risk rather than paying it out to reinsurers. And hopefully when that business is good and produces strong returns, we're able to keep more of it because of our financial strength, driving a bit more profit. Now we want to be very mindful and not to get too aggressive or too out of control. So there's lots of controls we have around governance and how do we invest. But a growing capital base, a growing surplus means a lot. So next slide. So I taught, whoop, sorry, one back. No, too far. Keep going, back. No, too far. You're going the other way. Mernice, you there?
Yes, I'm trying to work on it here.
That's all right. Go back to the
Sorry
slide
about
with,
that.
go
I
back to
missed the
this.
slide.
That's
Tammy's
right.
coming to help me with it. Here we go. All right.
Thank you.
So where do we stop? Right here.
Right there.
Okay.
Yes. So thank you.
Slideshow right here.
This is a shameless plug for our fantastic team and our board, who also supports our strategy. I just mentioned Cardinal received a national award. I serve as a judge for this group on a global basis, the Insurance Investor. It's a large media group focused on the insurance investment industry, which manages several $1 trillion of business globally, multi-trillions. And we were nominated for Insurance Investors North American Insurance Awards as a company. And we were among great competitors. And I've banned the word small about builders in this company, but we are the smallest of these companies you see. These are fantastic global brands. So you all should be proud. I am particularly proud that we ran shoulder to shoulder with Sun Life, who is our portfolio manager on our bond side, Zurich, one of the global elites, massive insurance company globally, Aspen, one of the foremost reinsurers in the world, and certainly Lloyd's of London, the 300-year-old heart of the global insurance and reinsurance industry. And we were a finalist among these 5 companies out of dozens and dozens of nominees. And I have to thank Chesley for her support in getting us building our nomination. We didn't win, but particularly proud that Builders made the national finals. What does that mean? Yeah, it's great to be nominated, great to win and be a finalist. But what it really speaks to is the quality of our portfolio management. To be in the same category as these folks is just tremendous. Now you can move to the next slide. Excuse me, folks, I'm fighting some allergies, so bear with me. All right, so the essence of this discussion is how do we make a dollar? We talked a little bit about earned premium and hopefully good losses that produce profits. Now our portfolio is absolutely integral to our returns. We have 2 primary objectives. And think about your 401k, for example, or your college fund, how you might invest that for your children, or even your if you have a flexible spending account here, your HSA, that money's managed as well. So Builders is no different. We have 2 core objectives at this company: yield and duration. Our yield is a function of how do we generate a return? Now, currently, we've restructured our portfolio recently, and that is one of the reasons we received being a finalist for the national award. Late in 2023, we looked at the future, we looked at the markets, and we saw a very good opportunity to sell out of a very large portion of our bond portfolio. And folks, think about our bond portfolio. It's about a 700 plus or minus $1 million portfolio. We'll talk about what's in that. But for this point in the discussion, think about United States Treasuries and corporate bonds. And so when you look at a 3.8% return, you go, gosh, my 401k returned 17% last year. Yes, it did, if you invest in a certain way. However, the investment rules around an insurance company are very strict and heavily regulated because obviously the government wants insurance companies to be healthy. And one of the ways they are healthy is the rules around investing. So we can't just go and buy crypto, which we wouldn't anyway. But we're not allowed. Could we do it a tiny, tiny bit? But the rules and regulations around our investment portfolio are very strict. So when we look at a 3.8% return, that is an excellent return relative to our peers and the company our size. So when I said we sold some of those bonds, if you think about the interest rate environment, as you all know, on a personal basis, the world didn't have high interest rates the last 10 years or so, almost 15 years since the global crisis. Now we're seeing rates tick up higher. And what we saw was a very unique opportunity for us to sell bonds that were only producing 1, 2, 2.5% for very long duration, very long periods to hold those. So we sold them and we took a bit of a loss, but we earned that back by reinvesting those several $100 million into higher yield, producing a higher return. So when we look at a 3.8% return, we also have the things that make that up. There are things earning 5 and 6%, and also things earning 2.5, 3, 3.5. So on a blended basis, we're pushing near 4% across our business. We also invest for duration. And what does that mean? We align our investments with our long-term obligations. Think about an injured worker that our nurse case managers are managing on the claims team. And that injured worker has substantial losses, substantial harm on a workplace injury. Think about a very seriously injured person. That's a very long-term case. And so we don't just pay out claims today. We also have to think about claims for the future, rising inflation environments, et cetera. So taking another example for that injured worker, think about their pharmaceutical benefits, not just today, but the cost of medical expense going up 3, 4, and 5 years from now, similar to a house that we have to pay a general liability claim. That house is built 2 or 3 years ago, but if you think about cost of inflation, even tariffs today, making costs go up, we have to think about all of that for the future. So we're not just grabbing a rate for today, we're really investing for duration. We think about the average duration of our portfolio, we're aiming for around 5 years, meaning we buy lots of bonds, and we'll talk about the maturity of those shortly, but we buy lots of things that look like 5, 6, 7, 8 years of duration because we want to grab good yield, good returns like that 3.8% or 5% bond, but we also want it expiring at a certain time so we know we can reinvest that money, hopefully at a higher rate. But we all map it to the duration of our overall portfolio. And we look at injured workers, we look at general liability claims, we model out and we try to invest for around a 5-year duration. As I said, this is a highly regulated strategy. There are strict rules. We review in depth every board meeting. We have to approve those. Those approvals are then reviewed by the regulators every quarter, every year. So there's all kinds of governance, very strict governance that goes around how we manage that portfolio. Next slide, Mernice. Thank you. So we talked about all that money. What do we do with all that money? This is a snapshot. This pie graph and the bullet points are representations of what do we do with it. And we're going to get into a bit more detail as well. Then I'll pause for some questions shortly. If we think about this 1.1 or so billion dollars, this is a representation of almost 60% is bonds. Cash, we hold about 9% in cash. We need that obviously to pay our bills kind of every day. There's always, Angie Wheeler's always processing and paying payables. And so the business never stops. We always have to pay rent every month and these kinds of things. So we always hold a pretty sizable cash position over at the bank. And then we own some common stock of companies. And we'll talk about what are those common stocks. Other investment assets. Those, if we did invest in crypto, that's where that would be, other invested assets. But those are the things that we're allowed to, under the government rules, to invest in that are beyond regular common stock and cash and bonds. So we want a good diversified portfolio, just like hopefully you have in your 401k. So we never aim for the max performance, but we also want to protect the downside. The downside of our portfolio. So when the bad day comes, and you all have seen, it's been a pretty bad day for about 3 or 4 weeks now in the global markets and certainly the US markets. And so we never want to be too exposed to that either. And our portfolio is doing exactly what it is planned and designed to do. So what do we look at when we invest? market conditions, very hard to predict the future, of course. Regulatory constraints, that governance that applies to us. We look at economic trends. We look at house building figures. And one of the facts I read this morning in one of the national press was they think there's a 4-year glut, excuse me, a 4-year shortage in housing in America, meaning we've got to build nonstop to just make up the housing that we're missing in America. So a 4-year stretch, which means we'll never hit that. And there will be another longer stretch. So it's bad for housing for people who want to buy homes. It's particularly good for builders as a company, meaning there's going to be hopefully no shortage of opportunity for us to ensure business going forward because of the housing gap. So think about a housing shortage. That's good for us. What's tough is when the interest rate environment for lenders for people to buy houses, that can slow down housing. But we do feel good about the future in terms of production because there is that gap. Why does it matter? Because then we can sell and grow our surplus space. And of course, we look at long-term sustainability goals, not just sustainability in the green sense around governance that way, but sustainability about our company and investing for a very solid duration and continuing just to build that surplus base. If we look back, our surplus, our portfolio returned nearly $35 million in income to this company last year, which helped us pay for a lot of things like our Guidewire investment. So next slide, please, Mernice. So before I get into the portfolio, I'm going to try to tie it all together. I know it's a quick high-level summary, but I hope it's been valuable in these 30 minutes or so already. We look at profit from our earned premium, and that really think about earned premium less losses, less claims. And then we apply investment portfolio returns that we just described. All that turns into income after tax, and that pays for salaries, health insurance, rent. And anything left over is pure profit that goes to surplus. And that's that 22 or so million that went into our surplus this past year. And there was a graph on the previous page. I was remiss. I missed that. There are no hardcore numbers there, but we did talk about on the town hall, that graph represents a growing surplus base. It is our financial strength, and it is a hallmark of this company, a company our size, having nearly 400 million in surplus. And I believe with a fair wind this year, we'll get close, or we'll exceed 400 million for the first time in 2025. That's bringing it all together with premium, less losses, taxes, plus investment returns. That's our profit. Now, I'm going to take a sip of water while Mernice goes to the next page. We'll talk about our portfolio. So I hope this is helpful. This really gives you a snapshot where there's about 4 slides here. So I'm going to try to cover those in the next 10 minutes, 15 minutes or so, and leave a little time for y'all to have lunch, since it's a lunch and learn, and answer any questions. Excuse me. So on the left side, you see our portfolio summary. This is our book yield, and you saw about 3.8%. And that's, if you look at the 12/31/2024 pre-tax book yield at 3.72. So we're right in the 3.738 range. Our value is there on the right, well, both columns, and we look at income. So for the 9 months, those are the numbers on the left at 9/30, and about 26 million pre-tax. So I was a bit high on what it produced for the year, but so forgive me on that. And then we think about, I talked about duration, about that 5-year range, and that's specifically what you see on portfolio duration. That is hugely important because we're always trying to tie our duration to the exposure of this company. And if you reach too far in duration or not far enough, then you're producing, you're liquidating things you don't necessarily want to liquidate. Think about selling your bonds maybe sooner than you want to. So we're always trying to tie our portfolio to how claims arise in this company. It's a very difficult thing, but there's a lot of science that goes into it. Now, below that, sector allocations. What is that? Well, if you think about your 401k, you might be a modest risk taker, or you might be an aggressive, or you might invest in one of those what are called lifestyle funds or age appropriate funds. and they will have a host of bonds and stocks. And that's what we are doing here when we think about sector allocation. So our portfolio has about 7% of just pure government bonds. Think about state bonds, think about federal instruments. We think about the US government issuing debt. We have about 40% of our portfolio is in credit. Those are credit instruments. And then we have taxable municipals and securitized, meaning mortgage-backed securities, things like that. We'll get into that in a minute. And then we look at pre-tax income. On the right, those are just, I won't go into those, but they're valuable to read. And it's what are we doing in real time? So this is the stuff the board, the management team, and certainly our external advisors, we go over constantly. And then on the bottom on the right, you'll talk about, we see earned income. And that's what this portfolio produces for us. So it's essential to drive solid returns, to give us profit, to help us run our business. Next slide, Mernice. Okay, this is getting a bit esoteric, but it's really important. Effective maturity schedule. Remember, we talked about duration. So if you look down the left column and going way into the future, and then if those are the years ahead, obviously, book value. So if you see figures like 25 million, 19 million, 48 million in 2026, these are the amounts we have invested that are maturing in the year that you see on the column on the left. So if let's pick down in the middle, 2038. It's a long way ahead, but we have $4 million that we own in our portfolio that mature in 2038. It is producing a value, a book value of 4.2, and it represents on the right about 1% of our total portfolio. What does that mean? Well, we've invested $4 million on a pretty long duration instrument because it's kicking off a really nice yield at 4.2. Go down just below that, we've got about 3.4 million in 2040 maturing at 5.31%. So we're going to get a 5.31 return for many years ahead. That's a really good thing. Think about it kind of like an annuity. Sometimes people think annuities are bad words, but the right annuity is a really good thing when you can lock in a rate, predictable rate for a long duration. That's exactly what we're doing here. And then going way, way out on the maturity on the scale, if you think about 2050, we own about $2.2 million at about a 3% yield. Why do we have it? Well, it's a good yield, and we have a balanced portfolio. So we want some way out there, but most of it you'll see is in those years. If you count from 2025, 5, 6, 7 years, the bulk of our portfolio sits in that range because that's where the bulk of our losses will come through. And as time goes on, you'll see those numbers shift down. When 25 expires, other reserves going in the future, you'll see those numbers grow. So 2035 will ultimately grow, but for today, relative to our book and our exposure, that's what we own. So I hope that gives you a snapshot. When you add all that up, there's about $450 million in bonds that are maturing. Just below that, we'll get into it in a second, you see 3 little letters, MBS, mortgage-backed securities. And those are instruments that we invest in that represent your house, the apartment building you may live in, my house. And so those are instruments that we invest in that allow for housing to be built around the United States, and lots of insurance companies doing the exact same thing. We'll get into that in a second. Put it all together, it's about $700 million, and that's our invested portfolio. Next slide. Now, because it drives such a big part, this is just a quick snapshot around asset allocation. We talked about your own 401k. Here's the actual values we hold on what I just described to you a moment ago. Let's go to the pie chart. I love pretty color pie charts because it's a real quick way to show the snapshot. So our core fixed income, think of that bond portfolio we just talked about. It's about 74% of our total invested assets, for example. Now, if you go to the left, we talked about how much cash do we hold at a given moment. This is our 12/31 numbers. This is our year-end number. Our cash position was about 20 million bucks. And that helps us just keep a good liquid position so we can pay bills without having to go tap our credit facilities. We have a large credit facility with our bank. We also have a credit facility with the Federal Home Loan Bank, and most insurance companies in America do the same thing. So we go to the government from time to time. It's a good, inexpensive resource for cash for insurance companies. And so we'll use that strategically from time to time when cash runs a little bit low, just because of how the spending hits during the course of the year, but a very natural way to run your cash position at an insurance company. Going down, our biggest sector that we talked about, core fixed income. Think of those bonds, 650 million. Just quickly, our target is what we establish where we want to be as a company and how we blend all of these things together to run our portfolio. If you look at all of those targets and then you look at the range, well, we target 74% in our core fixed income, that 650 million. The range that we are allowed to, both as a company and our approved guidance that our governance that we have internally, is a 65 to 98% range. That feels big, and we're right in the middle of that. If you think about 74, 75%. So we always watch that measurement. Are we right in line? You heard about, when you read finance articles about, again, I talk a lot about your 401k, about balanced portfolio and asset and sometimes rebalancing your portfolio. So we're constantly looking at that and how do we rebalance relative to the dynamics of our company real time. And just quickly, again, if you add it all up, when we think about the figure I gave you earlier was that about 700 million. Well, this is a little higher, about 884 million, because it represents a few more things that we invest in. We're going to talk about that in a second. Like high yield bank loans, CLOs, collateralized obligations, lending obligations, international equity. We actually own some international stocks. We own some real estate equity. We don't own houses, but we lend on things like that to other people who invest in that sector. So next slide, please. And folks, if you want to go back to anything in your Q&A, happy to jump back to any of those slides. I think I'm nearly done with the slides. So this one, I wanted, why is this one important? This shows you, we talked about that long list of years when bonds expire and we're going to be able to reinvest those dollars when the maturity happens. This is a graphic representation of just that. So this shows our pro forma book yield. Remember, we talked about today about a 3.8% return over our book. So if you look at our yellow line, it's kind of gold on my screen, that is our pro forma book yield. And this shows you over the longer duration, if you go out to the far right, 2034, well, that pays a bigger yield because we're taking a longer duration. We're able to invest that money for longer. And when you go longer, what we call out on the yield curve, it naturally has a higher return. So we don't want to put all our money out there because we need cash and near term to pay claims the next several years. But when we can grab a yield like a 4.88, if you look way out to the right, that's a really substantial yield for an insurance company. So if you look at it, we have about $74 million in that gray column for the bond maturities. We have about $74 million expiring around 2034. And that blended overall yield is almost 5%. That is a big deal. Now, if you go back to the left, of course, you'll see a lower yield because it's shorter duration stuff. No different than your cash account at your bank. If you have $1,000 in the bank, you're not going to get a big yield. One, banks don't pay a lot. But if you take that $1,000 and you buy a CD, and you buy a 12-month CD, you're going to get a slightly higher yield. If you buy a 2-year CD, you're going to get a little bit higher yield than your 1-year yield. No different than here. It's exactly what's happening here. The little red line is the yield on bond maturities. So, excuse me. And there's a bit of an anomaly in there. If you follow the red graph, around 2030, there's a bit of a dip around 2.94. And why is that? Well, it's because the way we had to invest at the time, we didn't find things that were higher than that. And so we stuck with it. And then when you sell, like I talked about in late 23 into 24, we sold a good bit of our portfolio to capture those higher yields. And so this was a product of modeling, et cetera. Where we find obviously great attractive returns is around 2033, about 100 million of our portfolio, give or take, it's about 8-9% of our entire portfolio, is kicking off a really good return. And so we're pleased with that. So I hope that gives you an idea of how we look at the investment of such a substantial amount of money. I think there's one more slide, Mernice, and it may be Q&A. Yes. So one more thing that I felt important here is we talked about, great, it's all a bunch of bonds, that's awesome. But this shows you exactly what we do. And there's some names there, but behind this one, we'll get into what we actually do with that. So we talked about Sud Life at the very beginning, our fixed income. They run our what we call the bond portfolio. Again, about 650 million. Barings is one of our investment strategic investors that we invest in, and it's a global investment group. Conning, no different. Conning is a very large asset manager. Proud to say that Sal Carenti, who you have heard his name probably, on our board of directors, is the former chief executive officer of Conning. So he is. We're very fortunate to have such an investment expert on a company our size, the board our size. So Sal is integral to our investment strategy and provides a great deal of strategy. I wear the investment hat at the life and company, or did for the past couple of years, investing, managing our portfolio of about $5 billion in the US for the life company, the board I sit on. So Sal and I wear similar hats. He wears it for builders. I wear it for a company called Sagicor. But Conning runs hundreds and hundreds of millions of dollars nationally. Just picking a couple of other names, you're probably familiar with Vanguard. They, in fact, run our 401k as an investment manager. We invest in Vanguard, but we invest in a very specific part of Vanguard, and as we do for all these others. So next slide, please. So what do we do with these? So all those investment managers you just heard, this is what they invest in. And so we look at consumer discretionaries on the far right, the second line down. Think about Coca-Cola and toothpaste, Johnson and Johnson, for example. We invest in commercial services, staples like food and energy. So we'll buy power companies that pay great dividends. And this is really our sector stock portfolio, if you think about that. Healthcare, for example, down at 13%. Our biggest healthcare holdings, you'll see on the left. Eli Lilly. We own a good portion of Eli Lilly for our portfolio. I'm a big fan of AbbVie, which is a fantastic vaccine and drug manufacturer that most of you buy AbbVie products every day, every week, certainly every year. So we hold AbbVie, which is a fantastic dividend stock. So think about those really premier blue chip stocks like Apple, Microsoft, Broadcom. Energy, we hold a little bit of ExxonMobil. We own a bit of Alphabet. So that gives you an idea of what the stocks we invest in. Now, we don't have a lot of stocks relative to our portfolio because we think it's not necessarily the best time. Yes, we always hold them. We try to hold the best stocks to kick off a yield, but also good solid returns over time. And certainly that's paid dividends for us because we sold a bit of our technology last year to invest more in longer duration yield. And that's really been a good strategy for us. It's produced a really nice profit for us. So I hope that gives you a snapshot. Hey, what does a builders invest in? Well, this is what we hold. Some of those companies right there in front of you, names you hear every day. You buy stuff at Home Depot. Well, 2.3% of our domestic equities that we buy is Home Depot on our portfolio. So I hope that gives you a snapshot of the stuff we actually do buy and the names we buy and the sectors we buy it in. Next slide. So now I appreciate that. I wanted to talk right at 45 minutes. I'm about 42 minutes. So be delighted with any questions. And if there aren't, I hope this was valuable, but I'll ask Mernice. Mernice, any questions from anybody?
We don't have any questions in the chat, but I
Uh-huh.
do have a question.
Yes, ma'am.
I was taking notes. First of all, I thought this was amazing. I hope our audience found it very insightful, but this was extremely excitable for myself. So I saw that we had a AA negative rating.
Right.
So can you kind of give us a little bit of hint or some insight as to why we have a negative is thought of as a negative, but that's not
Right.
necessary when you're talking about AM Best. So I thought
Right.
enlighten
Right.
us a little bit. Okay.
So can you go back to the slide if you remember?
I do remember it was like one of the earlier slides.
Okay.
I'm going
See
to
if
go
you
all
can
the way
pop it up.
back and see if I
That's
can
fine.
find it. But I thought that was very good that you would be able to tell us a little bit. Oh, hold on. So let's see here. I saw it in our here.
It's
I
probably
think one more
our holdings.
right here. So it says we have an
Uh-huh.
average credit rating of AA
Right.
minus. Okay.
Right. Great catch. In fact, that's actually a fantastic rating. So this is separate from what we think about as our AM Best rating, which is A, and it's at the top. So A is a great category to be in. There's only like A plus and A double plus, and so we are an A with AM Best, and we're also category 9 financial group size, which is 250 million in surplus to 500 million in surplus. So we'll be category 9 for a while until we actually break out above 500 million. This double A minus, it speaks to what we invest in. And so the portfolio remains high quality. So we're always focused on the quality investments. So we don't buy risky stuff in the larger sense. And think about risky, that would be like B plus, B double minus, what we call high yield. And high yield produces a higher yield because it's way riskier. And so we try not to go there because your chances of default increase. That's why you get paid for more risk. So we take sensible risk in the A, double A minus, triple A. And so we're always modeling, looking at the portfolio relative to that. So it's a good catch, Mernice. It's actually a positive and not a negative.
Awesome. I thought so, but I wanted you to explain it to me so that
Yeah,
I
yeah,
understand.
absolutely. And
So let's see if we have any other questions.
sure,
Okay.
I think
So
Eric
Kat
had one.
says on slide 10 on the maturity schedule, there are a few jumps in the book further
Yep,
out than 7 or 8 years. What is behind
right,
those types of increases? So let's go to slide 10.
right,
And it says further out 7 or 8 years. What is
right.
behind those types of increases? Okay.
Yeah, so so we talked about this, and then the next slide is helpful as well. But we like, for instance, look at 2043. There's $11 million in there, representing a 4.33% book yield. That's a very good yield. And so when opportunities like that, so remember, it's not a lot of money relative to the size of our portfolio. Think about $800+ million that we invest. So it's a small portion of our portfolio. And then but we do need to think about the long term. But again, looking back 25 to 2034, that's the bulk of our money. And that is where we know claims are coming up. And we have to think about that average duration because we know claims are going to hit when we sell a policy on a house today. Those claims on a general liability basis come through in several years, not necessarily right away. Will some come through? Of course. But problems with houses and construction really manifest, should they show up later in the life of the house. Think 4, 5, 6, 7 years. And that's why we invest for a longer duration. Think about that injured worker we talked about who really is costly. And sadly, they've got some serious injuries. Think about a paraplegic, for instance. And we've got to make house modifications for that family, for that injured worker. We've got long-term rehabilitation expenses. Think about Shepherd Center, for example, paying very expensive care. So we want to make sure we've got cash nearer, but we want to make sure that cash is producing a good yield to at least keep up with inflation and hopefully outpace it. So if we can go to the next slide, I think that might speak a little more to the question as well. Sorry, one more. Yeah, this one. And that's that jump that the person asking the question is asking about. So again, if you take that gold line out, it represents a higher yield going farther out, meaning we're investing for a longer duration. Those companies that have our money, they get more time to work with that money. So they want to make a profit too. So they're investing and trying to make money off of our money for us while they can make a fee on a growing asset base. So they're also strategically investing for the long term. Again, we talked about a little dip around 2030, about 43 million, kicking off about a 3% yield. And that's very, very strategic. And so we probably see losses in 1, 2, 3, 4, 5, that's 6 years out. So we want to have a good bit of money in those early years, going out to about 2033, 2034. And so it's we want to get it right as best we can. There's no crystal ball, like they say, but we're always trying to invest for good yield, but also respecting our cash needs as our losses come through, as our losses happen. So what we don't want to do is have to sell a bunch of stuff. Just like if you sell your stocks or sell in your 401k, you're gonna have to pay taxes on it. And if you have to sell when it's low, you don't want to do that. So all these people jumping out of the market right now are probably taking losses, and you got to pay taxes on that. So we want to invest and hold that so we can make those profits to support our surplus. So hopefully that's answering the question. I thought Eric Barlick had a question I saw
He
come
did. He
through.
did. Last question. Eric's question is, what's the singular most important investment to pursue in terms of return on the portfolio side?
Yeah, man, that's a good one. I think from as we think about our company and protecting our surplus and making sure we've got money to pay, and whether, let's say, we go into a recession, for example, a well-managed insurance company, which I believe we are, is very recession resilient. It's never no company's recession proof, but there's a lot of talk about what's on the horizon. So to Eric's question, what helps us carry the day? What helps us last and be resilient and sustainable? Well, it's a quality portfolio and good underwriting. And we've got both. We talked about those troubles of our general liability product from years past, in 2013, 2014. We're still feeling that. We talk about it. We can't hide from the bad news. But think about Eric's question. What is the single most important investment strategically for this company? And it is a high quality, very well managed bond portfolio. Those are the instruments that pay year in and year out. They're solid. They don't go up and down like the stock market. So what do we want? I go to bed every night thinking about all 205 of us, or our number, plus everybody's family members and our rents and mortgages and school tuition and daycare and healthcare. And what helps me sleep at night is a bond portfolio, to Eric's question, a bond portfolio that's well invested, producing good solid yields for a good long time. And that's what we've done in restructuring our portfolio about 2 years ago. That's that solid yield. So Apple can go up, Apple can go down. Home Depot goes up. If you watch Home Depot, it's moved nearly $100 in the past 4 or 5 months, well into the 400 range, down into the low 300s right now, because people are talking about a recession. And when recessions happen, people don't go to Home Depot as much. So thinking about the future, the stock market is a forward-looking tool. And it looks at the markets and goes, well, if people are buying stuff at Home Depot, that stock becomes less attractive. Bonds, when you invest them and lock that rate in, they are not, they don't fluctuate in the same way the stock market does. So when we look at all of it, we bring it all together. We want a solid portfolio producing solid, sensible yields that are predictable, kind of day in and day out. That's the hallmark of a well-managed insurance company, to Eric's point, and that's what we've got. So that is the single most important part of how we invest our money.
Wow. Thank you, Todd. Yes, it was amazing. What an insightful session. And we just, I'm
Thanks.
gonna think it's just on behalf of myself, everyone here in people development and people ops and the entire builders organization, just thank you so much for walking us through this.
Yeah,
I've worked in the industry a long time, but I've never had an opportunity to have this insight in terms of how we make a dollar at an organization. So we
yeah.
appreciate you. Thank you.
Well, I'm just delighted for the opportunity. And to everybody on the call, thank you for tuning in. I hope it's valuable. I never want to waste anybody's time. And you know me, I can chat a lot. But I do hope this was on point. And I would like to thank, in particular, Mernice and her team. 2 years ago, we didn't have a learning and development team. And as a growing company, as we move towards a high-performing culture, high-performing company, L&D, if you read the news and you follow attractive, high-performing companies, L&D is instrumental and crucial to a high performing company. And I just want to say, Mernice, the work you're doing, your team is doing, and we're all customers. We are your customers, and you are working hard to deliver for the customers on this call. And to anybody else on the company on the call today, keep asking your questions. And we want you well informed. And always, if you have more questions, come see me. Always happy to chat. And there's experts on this call. Tony Barner is an expert on this. Chesley Belcher is an expert on this. And there are other people, not to be exclusionary in any fashion. But just remember, it's premium. So everybody's important. I'm grateful for everybody and the work you do on this call. But when we sell and have a growing book of business that we can earn on, and our claims are well run and controlled, and we got the best claims team in the business, got the best underwriting and sales team and marketing team in the business, and we bring all that together and we invest that portfolio, we produce profits that pay our salaries, pay these bonuses, your 401k match, 401k bonus, profit share. It all matters. It all goes into this. And this is what we're hugely focused on every day. So thank you, Mernice. And thank you, everybody, for tuning in. I wish everybody a great rest of the week.
Yeah, it's our pleasure. Thank you again. And thank you everyone for joining us. A few things I want to remind you, don't forget to RSVP for our next Lunch and Learn, which will be in May. Thriving through change. We're going to talk a little bit about that and how we can help you manage it with confidence and resilience. And then one last shameful plug. I do want to invite you out tomorrow for our in honor of our International Women's Month. We have a women's luncheon tomorrow afternoon. We have a great lunch plan and then an afternoon dessert. And so it's going to be, we have an engaging speaker. Dr. Joseph is coming to from GGC. So it's just going to be an amazing day. And so we want you to, don't forget, please come and join us and stay tuned, stay connected with us on the bridge.
Oh yeah,
Until
and
next time.
well, she's great, Mernice, and it's going to be an awesome speech because she is an international. She grew up in Trinidad, and she's got an incredible story of how she got to the States and built a fantastic career in higher education. She is if you're going to have an awesome message from to recognize Women's Day, this is a woman to hear from. So, a fellow raised by four sisters, I can't wait. I'll be there with bells on. So, looking forward to it.
Very excited. Can't
Thanks,
wait for
everybody.
tomorrow. Thanks,
Hope you have some
everybody.
time for
Stay tuned on the
lunch.
bridge. All
Cheers,
right.
all.
Bye
Bye bye.
bye.